Well, this is a continuation of the last module. We had this situation where we need to now adjust the duration gap. They've decided they only want to adjust 60% of the duration gap, not 100%, because they're uncomfortable. There are practical issues associated with maybe some of these derivative positions that are being considered. And they're also willing to look at swaptions as an alternative to swaps as a mechanism of doing things. A swaption, remember, is an option to turn on a swap. The terms of the swap are negotiated, the fixed rate is set, you pay a premium, and then over a period of time, if you choose, you can turn on the swap. The fact that the fixed rate on the swap has been preset means as interest rates are going up or down, the right to turn that swap on may start to look good or bad. The swaption buyer will only turn on the swap if it is economically beneficial because of the change in rates. The seller of the swaption will be forced to do whatever the buyer decides. Terminology, when we talk about fixed payer, we are by definition talking about the buyer will pay the fixed rate. Swaption terminology, payer-receiver, always receives to the buyer and what the buyer will do with the fixed rate. That actually becomes pretty critical because they're going to get to a very complicated situation without understanding that terminology. Boy, you're totally lost what they're talking about. So fixed payer, it's always from the perspective of the swaption buyer. Receiver, that would mean the receive fixed for the buyer. So everything terminology is from the buyer's perspective of the swaption. You look at the new SFRs in the swap market versus the one that has been preset in the swaption, and you determine whether it's good or bad. Suppose I have the right, I have entered the right to execute a swap to, for example, pay 4%. And in the market pace, swap fixed rates have risen to 5%. I have the right to do something that is economically a bargain. There is economic value. You will execute that swap. And then if you didn't really want the swap, there's things you can do to offset and capture economic value. But you clearly have something with economic value. You do not let that option expire worthless. That's like saying I'm going to have the right to buy a stock at 50. The stock is worth 30, but I don't really want the stock, so I just won't do anything. Excuse me, I have the right to buy at 50. The stock's worth 80. You have a whole lot of value. Oh, but I don't really want the stock. I'm just going to let this thing expire worthless. Of course you'll never do that. There are ways you can capture that value. That's our issue. We know the buyer will exercise. Suppose it's a receiver swaption. Let's say again you have the right to receive 4, and in the marketplace, new SFR are 5. Receiving 4 is a bad deal. You would not do this. In contrast, if market rates have gone to 3%, the right to receive 4 is economically valuable, and you would exercise this swaption, or say more technically, it has positive economic value that can be captured. It is worth something. How do I look at and evaluate a swaption? Now, let's go back to our illustration. We're going to focus on what do you do with each technique to close the duration gap. I would suggest you focus on that. You should not consider the later issues until you are good with it. That is the building block of everything. From my experience, I know the Institute usually is asking the building block questions. They know this stuff is hard for most candidates, and they don't fill the exam with the hardest possible questions. Focus on that, no excuses. We will then also discuss, subsequent based on market conditions, which among strategies would turn out to be optimal. That's a sub-issue. If you don't understand the basic strategy, you have no chance of understanding the sub-issues. We'll also talk about some reasoning behind the optimality. I don't think there are no LOS. Explain the reason why. That is highly, highly unlikely. We do go spend a lot of time on it in the notes. We have some stuff in the candidate resource library, video going into that. It is not where I would suggest you focus. I think you would be wiser. Know the basic fundamental issue. How do you construct the hedge? How does it work? So remember, we had in the previous module a swap, 4.6 fixed versus 90-day LIBOR. We have a situation where the BPV of the assets now exceeds the BPV of the liabilities, and we had determined if we enter a pay-fixed swap, we are getting rid of some of our exposure economically to fixed-rate instruments. We will be lowering the BPV of the assets by entering a pay-fixed. Said another way, because the BPV of the A exceeds the BPV of the L, if interest rates go up, we will lose more present value on the assets than on the liabilities, and the surplus will deteriorate. So we're looking at a situation where our risk is a rise in interest rates. Pay fixed on a swap is one solution. There are, in addition, a swaption to pay 5.1. We do want pay, so buying the pay or swaption is another solution. That will, of course, cost an option premium. Another alternative would be a collar. We could buy that pay fixed swap, and we could sell another swaption. A receiver swaption would be the offset. Remember, a swap is a put and a call, a long and a short. We know, given our economic conditions, that we're at risk of a rise in rates. What we need is pay fixed swaption. If we want the collar, the offsetting sale would be to sell a receiver swaption. And the two strike rates are different, and they were selected so the premiums are equal. We can't just pick today's 4.6 FSR. The two would not have equal premiums. That wouldn't work. We need a collar with differentials, like you always need in a collar. And the Institute is making this a little bit simple. They're just assuming all PVs of all these swaptions are equal, because otherwise you're just into innumerable math that adds nothing to the analysis. Also remember, in this situation, the company has decided they're only comfortable with hedging 60% of the gap. So we go back and we find the BPV of the A, which was given in the starting last module, the BPV of the liability. We only want to hedge 60% of the gap, and we have the BPV per one notional principal of our swap. So for a 60% hedge, we need to pay fixed 4.6, the terms of the swap. So if interest rates go up, notice we're receiving LIBOR. This is going to be a good thing. This will provide mitigation to our duration gap. No excuses. Let me back up. What is the correct strategy? What is the correct calculation? Now, insight. When is this going to be great? If swap fixed rates rise above 4.6, the right to pay 4.6 has economic value. This is the good deal. We would want to exercise. However, if rates go down, this will not be good. It's a swap. If we turn it on, this is the swap. This is not the swaption. This is the swap. If we do this and rates happen to go down, this swap will not be a good thing. So we are locking in protection from rising rates, but if rates happen to go the other way, this wasn't the perfect strategy in that case. There's an upside downside. What about the collar? Now, you'll notice the lines here are dotted because these are rights to start something. These are swaptions. So we would buy the payer swaption. It happens the strike rate that's available in the market is 5.1. So if interest rates do go way up above 5.1, this will be a good thing. It won't give the immediate protection of the swap. And if rates go down low enough, we sold a receiver swaption. Now, receiver refers to the counterparty. So notice, the counterparty has the right to receive 4.2, which means the counterparty is going to force us to pay 4.2% if we choose to sell a 4.2 receiver swaption. That's what we've agreed to. So if interest rates go way down below 4.2, this will not be good. Between 4.2 and 5.1, neither of these has economic value. Nothing will happen. Choose to pay 5.1. Beneficial if rates go above that. We will be forced to pay 4.2 if rates go below 4.2. Not a good thing. So where is this optimal compared to the swap? If we go between 4.2 and 4.6, we're not locked in to paying 4.6 as we would be with the swap. This would have been better. And if they don't go below 4.2, we won't be forced in to this swaption that we sold. So between those two, if rates go the opposite of what we think, this would have turned out to be better. But wait a minute, if rates go way down, this is not a good strategy, the collar. Why is it not? Because suddenly you're being forced to pay 4.2 by selling. In that case, the optimal thing would have been only to use the payer swaption. Just buy that option and pay the premium. We don't have the immediate protection of a swap, but we also don't have to worry about a plunge in rates and being forced to do something as we would be with the collar. So this is a tough one to go through. Now the company can choose. They will do it. They will have protection if rates go high enough, i.e. above 5.1. Where is this optimal? Compared to the other two strategies, this is better if rates plummet. They've absolutely got to go below 4.2. Because below 4.2, we don't want the collar. We got to go back and look at the collar and say, the collar would have been bad, therefore this would have been better. But they've actually got to go a little bit lower than 4.2 before this pays off. The reason is we got to pay an upfront premium for this. Now the good news is they're not even attempting to quantify how much lower to deal with the premium. The information is here. I strongly recommend you focus on how do you implement each of these. And if you have time, look over the reasoning of what determines optimal versus non-optimal. What are they? How do you set it up? How it turns out to be optimal is not part of deciding how to set up the strategy. I would focus there. We actually did summarize what we just did, the BPVA of A above BPV of L. We also summarize BPV of A less than BPV of L. Everything reverses in terms of the thought process. We do have more coverage of this in the text, and so I don't want to spend too long on this. I think I'm misleading you if I do that. I want you to focus on how do I set each of these strategies up. I think that would be more valuable to you. We did also want to quickly cover contingent immunization because there's not that much you have to say here at level 3. It's a hybrid kind of a strategy. Unlike immunization, you must start with overfunding the portfolio. You must set it up with a PV of A in excess of the PVL. Because of that, you can actively manage the portfolio and take more risk. You have to monitor it. If your strategies don't work, and if the surplus starts to deteriorate, if it ever goes below 0, what that means is there's no safe way to get where you needed to end up. So you can't allow the surplus to become negative. You just have to monitor it. So as you see it starting to approach 0, you realize you're failing, you just got to stop and revert to immunization. When exactly do you have to stop? Neither I nor the Institute can tell you. But do any of you ever drive a car and you see a stop sign? When do you need to put on the brakes? You need to put on the brakes in time to stop before you run through the stop sign. Well, that's all this is. They can't tell you that. Just pay attention. Don't do these strategies if you aren't comfortable with them, and start putting on the brakes and revert to immunization before the surplus ever becomes negative. If you succeed, which is our goal, the surplus will grow. But if you're failing, at least mitigate the risk by converting to immunization before the surplus goes negative. That's the issue. Now, approaches to this. We can just manage the whole portfolio of assets. We can do whatever. The risk is if you do need to convert to immunization, you're going to have to make trades. What if the liquidity is not there to make the trades quickly? So you do have to be thinking about the ability to convert to immunization and how liquid is the market. What if there's a market crisis and you can't get it done? You just committed gross incompetence. Don't let that happen. Don't do these things if you're not comfortable with monitoring and if you don't know how to get out of it. So actively managing all of the assets is risky. Another approach would be, because we have more money than necessary, why don't you take the necessary funds and set up an immunized portfolio, and you could only actively manage the surplus part. If you're using long-only assets to do that, if they ever go to zero, your surplus is gone and, well, we didn't succeed. But if you're actively managing the surplus using derivatives, remember with derivatives, you can lose more than the initial investment in some cases. So you may be in positions where you have to unwind those derivatives. Otherwise, you will lose more than the surplus, and now you got a big problem. So even with derivatives, you may have to think about the liquidity issues. How do I exit if I'm unsuccessful in managing the surplus? That's a key consideration with contingent immunization.